The Fed has become very hawkish and aggressive, which is the bad news. The good news is that data is starting to come in that confirms the US economy is in recession. And if you've listened to us before, you know we believe that Europe and China have also been in recession for some time, making this a global recession. Additionally, there are many signs that prices are declining. So I believe that the assumption that everyone has been worrying about inflation is a misguided way to see the world at the moment. We've been emphasizing for a while that we think deflation is a far bigger risk. We've faced backlash for stating so, and we've faced challenges from those who are certain that inflation is returning to the levels of the 1970s. We believe that the pricing activity, and by pricing action, I don't just mean stock and bond prices, but also commodities prices, cryptocurrency prices, and even housing prices that many individuals will likely conclude in the near future. The greater risk is deflation, and as you know, we don't think deflation is necessarily a terrible thing. However, the way the Fed has handled it has been bad, and we believe that over time, there will be a lot of deflation brought on by advancement in technology. Horrible news, good news, darkest before the dawn. We believe growth will be rare this year, and as a result, we're going to have to get through this bad deflation. You are aware that innovation is all about expansion. We currently have a lot of difficulties. Thus, solving them is another aspect of innovation. A recession will bring up a new set of issues. Cryptocurrency saw its worst quarter since 2011, which is noteworthy given that the market is now considerably more developed than it was during the boom-bust period. The S&P is down 20% year to year, while the Nasdaq is down about 30%. So far, the stock market has not had a worse year since 1962, when the Cuban Missile Crisis occurred. What followed was the Great Society, which was characterized by guns. Then inflation and butter started to soar. But first, the stock market was on fire. From 62 to 66, it was really warm. If you piece together the bonds, this year's bond performance has been the worst in anyone's lifetime. If you want to set a record, the worst year for bonds has been since 1788, which is more than 250 years ago or almost 250 years ago. Consequently, the market has been extremely difficult for investors. We believe there is hope and that there is light at the end of the tunnel. The PPI and the CPI are trailing indicators that will eventually reflect the signals the FED is receiving. They have a lot of indications, and I predict that many businesses will hint to the recession in their earnings reports for the upcoming month, causing the Fed to pause and take notice of the massive, swift downturns. He essentially indicated that they are only focused on prices now that they have a dual mission, jobs and prices. Frankly, I'm pleased that they are focused on more of a pricing rule, so that's excellent. He repeated what he said in Jackson Hole. However, I believe that a significant amount of deflation in the system, which is already present if you look at commodity prices, will be the driving force behind the pivot. For instance, the gold price actually reached its peak in August 2020 and is currently at the lower end of a 2-year range, while the prices of copper, oil, lumber, iron ore, and other commodities have all fallen sharply. Freight rates around the world also suggest that the supply chains are loosening up considerably. The system is experiencing deflation as a result of the falling rates. And as I explain what is happening now, I was just starting out in my career in the early 1980s, when Volcker was slamming inflation with a sledgehammer. He required a sledgehammer because it was ingrained in the system after 15 years of wasteful expenditure on the Vietnam War, the Great Society, and then abandoning the gold exchange standard. That is what Chairman Powell, in my opinion, believes he needs. But we simply don't believe that to be the case given the amount of deflation we are currently experiencing, as well as the massive inventory overhang we see around the world, as well as the fact that China is effectively experiencing a recession, and that here in the United States. Retailers have a surplus of inventory that will need to be cleared out with discounts. As a result, we believe that inflation will decline significantly over the next 3 months. The PCE deflator, which the Fed is examining, peaked in February at 5.3%. It is currently at 4.6%, and we think some bad news has already been reported. I wouldn't be surprised to see it well down into the threes in the next 3 to 6 months, if not into that 2 handle, because nobody believes them. But we do, and we believe we're going to see some more negative numbers during the next 3 to 6 months. If we get enough sequential declines, I believe the Fed will change its stance quite dramatically. Even if we don't have that 2 handle, I believe that the Fed will be looking at the sequential figures, many of which will be negative. We're in the threes and dropping fast. I think they'll alter their mind, and we anticipate that earnings will be severely squeezed until some of these cost decreases are implemented and stockpiles are liquidated.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
We currently do not believe that this will resemble 2008 or 2009, which I know many people worry about. I believe it will be more of an inventory recession because of the drag from the rest of the world, including China readjusting to quote-unquote common prosperity and Europe being crushed by energy prices. There has been a lot of denial that we are in a recession, but we believe we are, and that we'll be coming out of it next year. I truly believe the market will be looking up as we're exiting this year, despite what many individuals and forecasters are saying. If you peel back the onion a little, the employment numbers have appeared to be strong, so we do believe that there has been some labor hoarding here. We are currently experiencing a lot of pain in the employment landscape because household employment, which includes many small businesses, has been essentially flat over the last 4 to 5 months. However, the labor hoarding is due to the fact that businesses were unable to hire workers during the supply shock and COVID. So now that they can, they are holding on a little bit longer than I think they would normally. If we increase to 6%, I'd be shocked. I do believe that the inventory recession will be somewhat severe and that the unemployment rate will rise, but I wouldn't be surprised to see if it reached 6%. As with most growth strategies, our strategy has been severely harmed by concerns about inflation and higher interest rates. But as I mentioned, we believe that this is about to change. We observe that these 5 platforms, which are 5 innovative platforms, are growing at an exponential rate. There has been a lot of confusion regarding trajectory, and we've seen many COVID-related comparative concerns in equities such as Roku, Teladoc, Zoom, and so forth. Although the market has relatively short-term indicators, the tremendous rise is real. It has already occurred, and we believe it will continue. We can observe this in the global public equity markets when we only concentrate on truly disruptive innovation, which is currently valued at about $8 trillion. We estimate that within the next 8 to 10 years, that number will increase to more than $200 trillion, representing 60% of the global public equity market, up from the current level of less than 10%. The reason for this prediction is that these platforms will upend the established order in a way that has never been seen before. These are 5 platforms rather than 3, and they encompass 14 separate technologies. We were not alive in the early 1900s when the telephone, electricity, and the vehicle upended the established order of things. Because of the compression in our performance, we have reduced our flagship strategies holdings from 55 names to 33 names. We did the same thing during COVID, but that was only a 1 month worth of pain and an inconvenience. If we are correct about what is happening in the economy right now, and inflation is going to come down fairly dramatically, that will be a big positive for growth stocks. That was ahead of its time. We rose by 360 points in less than a year, over a month, and from the COVID lows. We have made significant corrections, and there are now numerous equities that I would classify as deep value stocks. If you give us a 5-year investment time horizon, I'll say that the market has priced at least 4 interest rate hikes into the 2-year treasury and the market itself. This possibility is also increasingly priced into the equity markets, and if anything, rising oil prices are a terribly onerous tax on the lowest socioeconomic demographic sectors of our economy. You may have heard me mention this before, but I believe the worries in this area will shift from potential recession to rising interest rates and increased inflation. This is because we are witnessing an ecosystem-wide buildup of inventories.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.